Okay, so in this illustration, this is short exercise 3-2, and we're going to look at the cost flows between inventory counts for the following example. So it says Parker's Wood Amenities is a manufacturing plant. They make picnic tables, benches, and outdoor furniture. They want us to indicate which inventory accounts would be affected by the following actions, which occur at Parker's in the process of making its picnic tables. Also, they want to know whether the inventory count would either be increasing or decreasing as a result. So remember, this is all about cost flow. So in letter A, it says lumber is delivered by the supplier to the plant where it's stored in a materials storeroom until needed. So guys, this is going to be raw materials. So I'm going to draw a T account down here just to indicate this is where it would go. So in letter A, you would be increasing your raw materials account. In part B, it says you are requisitioning lumber into the storeroom to be used for tops and seats for the table. So guys, that would be production. So in that case it's going to be going into work in process. So in letter B, you'd be increasing work in process and you'd be decreasing your raw materials. So just by indicating the letters, increase WIP, decrease raw materials, because now you're starting to produce. In letter C, it says factory workers cut the lumber. So that's basically direct labor. So that would be letter C. That would also go into work in process, because that's basically your that's also part of your product cost number 2. And then letter D, it says 10 tables are completed and moved to inventory. So we know that would be finished goods would be increasing. So that would be letter D. And of course, you'd be decreasing work in process. Finally, letter E, it says a customer purchases a table and takes it home. So in letter E, you'd be decreasing finished goods, and they didn't ask for it, but I'll put it in here. And of course, you'd be increasing cost of goods sold. Okay, so for this illustration, we're going to be looking at short exercise 3-4, where it says to compute a professional billing rate. So it says Amy Gentes is a new staff accountant at Johnson Associates. She is paid a salary of $60,000 per year and is expected to work 2,000 hours per year on the client's jobs. The firm's indirect cost, so this is the overhead, the indirect cost allocation rate is $25 per hour. They would like to achieve a profit equal to 30% of its cost. All right, so number 1, it says convert Amy's salary to an hourly wage rate. So you'd have to take the $60,000 annual salary divided by the expected hours, which is 2,000. So that would put you right about $30 per hour. That's basically her labor rate. That would be part 1. So put $30 per hour. Number 2, it says calculate the professional billing rate they would use for billing clients' services. So in this case, it says they've got the firm's indirect allocation rate is $25 per hour, and of course that's what you'd be allocating per hour of work. So if you would take essentially the direct labor per hour, which is $30, and you're going to add in that overhead, which is said to be $25 per hour, that basically means your cost per client is essentially $50 per hour. So that's your cost. That's basically your product cost. And if you're going to mark it up 30%, you just take that $55 and you can multiply that by 1.3, and that'll give you the markup, what you'd charge your customer, which in this case it looks like that would be $71.50. So that would be the professional billing rate. You're going to basically, this is your sales price, which is $71.50. Your cost is $55. So basically, if you take your sales price of $71.50 and you subtract out your cost of goods sold, essentially, which is $55, that would then tell you your profit margin. Okay, so we're going to do 3 of these back to back. So this first one is going to be short exercise 3-5. And then whatever we get in 3-5, we're going to use it in 3-6, and then it's also going to be used in 3-7. So let's get this started. It says Demo Pools makes swimming pool equipment. They estimate their total manufacturing overhead cost to be $1,525,000. There's their estimate. They also estimate it will use 61,000 direct labor hours and incur $1.220,000 of direct labor costs next year. It says, in addition, machines are expected to run at 38,150. Compute the predetermined manufacturing overhead rate for the next year under the following independent scenario. So 3 different assumptions. So look at the activity base under assumption number 1 is direct labor hours. Under assumption number 2 is direct labor cost. And under assumption number 3, it's going to be machine hours. So the numerator is going to be the same for all of these. It's 1,525,000 is the estimated overhead. So for example, for number 1, you would be dividing that by the 61,000 direct labor hours. So that would put you right at $25 per hour. So that would be your rate for number 1. Number 2, again, is the same overhead, 1,525,000, and using direct labor cost, which is 1,220,000, that would be your denominator. So in that case, you would get 1.25, or you would say that's 125% of direct labor cost. That's your rate for that one. And again, the third one, 1,525,000, same numerator, divide by the machine hours, which is 38,125, and that would give you about $40 per machine hour. Now remember, the thing about job costing and allocations is you want the activity to approximate or to be an indicator of overhead. It's all that cause and effect relationship. So we've got 3 different rates here, and the goal will be, once we start to do some allocations, which of these rates will be the best indicator of the actual overhead that's actually taking place. So we'll use this data as we look at short exercise 3-6. Okay, so in 3-6, it says use the answers from 3-5, and we're going to do the allocation. So on number 1, if you recall, the rate was $25. So again, we got the rate times activity, and so it was $25 per hour. We're going to multiply that by 62,550, and that's going to be our allocated overhead. We're going to get right at $1,563,750. So that would be your allocated overhead using that as your rate. On the second one, remember, it was 125% of direct labor cost, so you're going to write that out as 1.25. And if direct labor cost is 1,245,000, again, rate times activity, so you would get right at 1,556,250. So that would be your allocated overhead under the second assumption. And then the third assumption, again, using the machine hours, it was what, $40 per machine hour. We're going to multiply that by 38,000 machine hours, and then that'll give us 1,520,000 as the allocated overhead using that assumption. So again, depending on your assumptions and your base, notice how each of these would give you a different allocated overhead. And again, at the end of the day, they didn't tell us in this exercise, but the idea is to see how close would these numbers be to the actual overhead, and most likely you're not going to find that out to the end of the year. But remember, the goal is to be accurate. So which one of these is going to be the best indicator? Well, sometimes it just takes trial and error. And then in the next exercise, we're going to be comparing each of these and seeing how close we did come to the actual overhead. Okay, so in 3-7, again, we just calculated the allocated overhead, and they tell us in this problem that the actual overhead turned out to be 1,550,000. So if we were using assumption number 1, I'm going to write this in a T account format. We had come up with allocated overhead. It was this was using the direct labor hours of 1,563,750. And remember, the actual always goes on the debit side. And so if you had to come up with a balance, look, it looks like we're off by what, 13,750. So it looks like in this case we are over allocated. So we're over allocated with selection number 1. Selection number 2, same idea. So we got the manufacturing overhead. You've got the 1,550,000 on the debit side. And remember our allocation we came up with, it was 1,556,250. So in that case, again, we were over again, but we were only over by 6,250. So again, over, but by 6,250. And then remember the third assumption is, again, manufacturing overhead, again, 1,550,000. And And I believe, let me check, it looks like our assignment, let's see, we had, was it 1,520,000? I wrote that down, 1,520,000. That was using machine hours. In that case, we were under by a good 30,000. So under allocated. So remember, the game is to be as close as possible. And so it says, were there any situations in which jobs were costed correctly? If not, when were they overcosted? When were they undercosted? So they were never exact. Clearly, number 2 is the best one. You were within 6,250 of actual. You were over a little bit. This one, you were over by a little bit more, by 13,750. So I would say if you had to choose a method in this one, I would choose direct labor cost, because that's the most accurate of these 3 methods. And again, you're going to learn in upcoming chapters that sometimes to resolve some of these problems is you'll end up using multiple rates because you have multiple activities. That'll be the next chapter when we get into activity-based costing. But for now, we're just assuming we're only using one rate, and we're trying to see which rate gives us the best estimate of actual. And in this one, it's clearly, in this case, it would be direct labor cost. Okay, so in this illustration, we're going to be looking at short exercise 3-8, where we're going to look at the overhead rate and then do some analysis for year-end results. So it says this one this is a company that makes playground equipment. Notice they give you the estimated overhead of $1,890,000 and direct labor cost of $2,160,000. So we probably will need these numbers. It says after the year was over, the accounting records indicated that the company had actually incurred $1,760,000 of overhead and $2,300,000 of direct labor cost. Part 1 says determine the predetermined rate and assume that the company uses direct labor cost as the allocation base. So remember, to get the rate, it's going to be your budgeted overhead, estimated overhead, that's our numerator, divide by the direct labor cost, which is $2,160,000. And so our rate in this case is going to be right at 0.875, or some might say 87.5% of direct labor cost. Excuse my handwriting, but that's the number you're going to use to do your allocation. So the rate is 0.875. Number 2, we want to figure out what our allocation would be. So again, you take the rate times activity, your rate being 0.875, that's your direct labor cost rate. Multiply that by the actual direct labor cost of $2,300,000. And when you do that, you're going to get right at an allocated overhead of $2,012,500. So that's your allocated overhead. So that's part 2. Part 3 would say at the year end, manufacturing overhead was over or under, and by how much. So again, I'm going to draw my T account. And remember, the debit side gets the actual. The actual overhead was given in the problem of $1,760,000. That goes on the debit side. The allocated overhead goes on the credit side. And clearly, you can see right here, we're going to be over by, in this case, $252,500. Over allocated is your answer. Looks like you've got some work to do because that's not very accurate. You probably want to be a little bit closer to actual. That could affect pricing, that can affect customers, that can affect a lot of things. So again, but just in terms of answering the questions, the rate is 0.875, allocated overhead is $2,012,500, actual is $1,760,000. The difference, we're over allocated by $252,500. Okay, so for this exercise, we are looking at short exercise 3-11. And for this one, we're going to show you how to do some recording of buying materials and using materials in production. So for this particular problem, we have Easy Packs. They make backpacks. They record their material-related transactions as follows. So notice we've got purchases of canvas on account, $67,000. Purchases of thread on account, $1,100. Notice these are both raw materials. We've got requisitions into production. So anytime you see that requisition, that means that's going into production. And in this case, we've got canvas $63,000 and thread $500. Make the journal entries to record these transactions. So I'm going to write these off over to the side. So for these first two, we can combine these. That's essentially your raw material purchases. So if you're going to write out a journal entry, you would basically be debiting your raw materials account. In this case, for $68,100, and you'd be crediting accounts payable AP for $68,100. So that would take care of the purchase aspect of this. Now, down below, I'm going to go ahead and write a couple of T accounts. I'm going to set up your raw materials T account, and I'm also going to set up the work in process T account. Okay. Now, if they tell us in the problem, it says we had a beginning balance of raw materials of $38,000 at the beginning of the period, so that's going to be our beginning balance. We just bought $68,100, so we're going to post that. We're going to add that to that beginning balance. And then it says that they want to know the ending balance. Well, remember, anything that we transfer from raw materials into production, the next step is always work in process. And in this case, it looks like they requisitioned $63,000 plus $500, so that would be a total of $63,500. I'll write the journal entry over here. What you're going to do is you're going to debit work in process for the $63,500, and you're going to credit raw materials for $63,500. Once you do that, you notice you'd post that to raw materials. So here's your credit of $63,500. You're basically transferring that down to work in process. So you'd be debiting the $63,500 into work in process. And at that point, we can then figure out the ending balance of raw materials. You got two debits and a credit. You basically just have to get the balance. You would have $42,600 left over at the end of the period. So to answer the question, we've got the journal entries. Here's the purchase up here. Here's the usage right there. And then the ending balance of raw materials is right there. And again, you can go and double check this on the textbook solution. Their format's going to look a little bit better than this, but this is the basic idea of how to do the journal entry and the ledger part of these cost flows. Okay, so for this one, we're looking at short exercise 3-12, and we're going to show you how to do some record keeping for the labor. So it says that Crystal Creations has the following labor-related transactions at its plant in Akron, Ohio. We've got the plant janitor wages, the plant supervisor's wages, and glass blower's wages. So when you look at this, you have to figure out what's our product cost here. Well, we know janitor is going to be overhead. We know that the plant supervisor is going to be overhead because these are all those indirect costs, but they're still in the plant. A glass blower is the actual direct laborer. So we know that's going to go into work in process because that's where direct labor goes. So remember, that's going to be the direct labor aspect. Everything else is indirect labor. So to make the journal entry, we're going to be debiting work in process, in this case for $70,000. We're going to also debit manufacturing overhead. Just combine these two. Here's going to be your total overhead. So that's a total of $1,420. And then you can put the credit. This is all probably most likely some sort of payable. You could put wages payable, for example, as a credit. That's good enough for $71,420. So notice this is how you record labor. Direct labor goes to work in process. Indirect labor goes to manufacturing overhead. Okay, so for this one, we are looking at exercise 3-18. We're going to work on getting an overhead rate, and then we're going to do the allocations to the jobs. And then we're also going to figure out the cost of the jobs. When I pasted this onto the PowerPoint, I couldn't squeeze in the last part, but part 3 of this basically says they want you to calculate the cost of the job. So we've got Boston Heating and Cooling. They install commercial heating and cooling systems. They use job order costing to calculate the cost of its jobs. Here's the big thing. Overhead is allocated on the basis of direct labor hours. You need to know that. That's the allocation base. At the beginning of the year, it says they have estimated overhead of $67,200. I'm going to write that right up here. Here's your estimated overhead. It says it anticipated using 4,200 of direct labor hours. So remember, to get the rate, we're going to be dividing by that 4,200 direct labor hours to get the overhead rate. It says in November, they started and completed 2 jobs. So we've got job 101, job 102. Notice we've got direct materials used, direct labor hours used, and then down here below, they give us the wage rate, which is at $24 per hour. So first of all, we want to get the overhead rate, which I just kind of already wrote here at the top. So 67,002 divided by 4,200 gives us a total of $16 per direct labor hour. That would be part 1. Part 2 says calculate the overhead to be allocated based on direct labor hours. So for job 101, they use 180 hours. So what you would do on part 2 is you take 180 and multiply that by $16. That would be the allocated overhead. So if you did that, you're going to get $2,880. And then for job 102, you take basically the 74 hours, multiply that by 16, and you would get 1,184. That would be the overhead allocated to job 102. And then finally, the last step is to get the that'd be part 1, part 2. The last step is they want you to get the cost of each job. So for job 101, you basically line it up. You've got direct material, you've got direct labor, you've got overhead. Direct material is 18,000. The direct labor is going to be 180 multiplied by the wage rate of $24 per hour, and that's going to give you, it looks like 4,320. And then the overhead we just figured out was 2,880. That's the amount that we're going to allocate. So if you add up the 18,000 plus the 4,320 plus the 2,880, you get a total cost of 25,200. That's how much you would cost this job out for job 101. I'm going to write this one over here for job 102. It's the same idea. You've got your direct material cost of 12,000. You've got your direct labor. You have to calculate it. It's going to be the 74 hours times the wage rate, which is $24. That turns out to be 1,776. And then the overhead that we just allocated was 1,184. So again, we got 12,000, 1,776, 1,184. You add these together, we get a total cost of 14,960. That would be the total cost assigned to job 102. Okay, this is exercise 3-20A. We're going to again use job costing to get the cost of a job and then use it to make pricing decisions. So we've got Fun Time Industries. They custom make playground equipment for schools and city parks. It says that they expected to incur $586,600 in manufacturing overhead costs. So that's going to be our estimate. It says 41,900 direct labor hours. And then of course they also give us the direct labor cost. Of course, the cost per direct labor hour would be $22 per hour. Here's the big thing. They allocate overhead on the basis of direct labor hour. So that's what we're going to use to get the rate and also to allocate. It says that they completed job 309. The job used 175 direct labor hours. It took $14,200 of direct materials to complete. It says the city of Southtown has contracted to purchase the playground equipment at a price that is 22% over cost. So first of all, let's get the cost of the job. So we need a rate. So I'm going to get the overhead rate by taking 586,600. There's your estimated, overhead cost essentially. The activity that we're going to be using is based on direct labor hours, which is 41,900. So what you essentially have to do then is divide, and you're going to get this right at $14 per hour is your overhead rate. Okay. Now, next up is we need to get the cost of the job. So this is job 309, so we need to know the direct material cost, which they give us. And it says the direct material cost was $14,200, so we know that one. The direct labor, sometimes they make you calculate this, and they do in this one. It says that you had 175 hours, and the basic labor rate they told you is $22 per hour. So we're going to multiply that by the labor rate of $22. That gives us $3,850. That's our direct labor. That's our product cost number 2. And then finally, the manufacturing overhead. Again, it's 175 direct labor hours. This is where you multiply by the overhead rate, which we just said was 14. And then when you do that, you get 2,450. All you have to do is now add these 3 product costs. We get a total cost of the job of 20,500. So if we want to figure out, so basically that's part 1, that's the cost of the job. It says how much will the city of Southtown pay for this? What are we going to charge them? You take the cost of the job and simply multiply it by 1.22. That's a 22% markup. So they're going to actually pay a price of $25,010. That would basically be the sales price of how much they would be paying. Okay, so that's basically the idea. Okay, 26A, I'm going to walk you through again all the basic journal entries in the cost flow setup for job costing. So in this case, we've got Jackson Fabricators during January, month of the fiscal year. We've got transactions A through F. We're going to do the journal entries, and then we're going to look and see what the overhead account looks like to see if we're over or under. So I'm going to start way up here at the top. And again, you can always go and check the textbook solutions if you can't read my handwriting. So part A says you bought materials on account. We're going to be debiting raw materials. That's going to be $195,000. We're going to credit accounts payable for $195,000. That's pretty standard. That's like financial accounting. That would be your first one. On letter B, it says we're going to use of this materials, 194,000 of materials was used in production. It says of this 167 was used on specific jobs. What that means is that is direct material. Everything else is indirect, which is going to go to overhead. So for the direct materials, we've got work in process. That's going to be 167,000. And so the difference between 194 and 167 is 27,000. So 27,000 goes to manufacturing overhead. And then we're going to credit raw materials for the 194,000. So that would take care of part B. Part C is going to be the labor. So notice the idea here is cost flow. So we've got direct materials taken care of. Now we're getting into some direct labor. And it says we've got $260,000 of labor. It says a total of $250,000 of manufacturing labor and salaries was traced to specific jobs. That basically means that's the part that's direct labor. So $215,000 is the direct labor part of it. So remember, direct labor goes into work in process. So we're going to debit work in process for $215,000. The difference is $45,000. That $45,000 is going to go to manufacturing overhead. And it says basically, assume if they haven't paid it, we've at least incurred it. So we're going to credit like wages payable. We'll call it wages payable for $260,000. Going to write that there. So that would take care of part C. Now we're on part D. It says they have $17,000 of depreciation on the plant, and they also have a utility bill for $9,000. All of this is manufacturing overhead. So for letter D, we can combine that into one account. 17 and 9 is 26,000. So your total overhead incurred there is 26,000. Remember, depreciation, the credit goes to the accumulated depreciation account. That's from financial accounting. And in this case, that's 17,000. And you could put the utility bill into accounts payable, and that's going to be for 9,000. So that would be letter D. Letter E, they go ahead and just tell you the overhead allocation. They've already did the rate and did the allocation, so you just have to do the recording. So you don't have to worry about calculating an overhead rate there. They've already done it. You just have to do the journal entry. So allocated overhead goes to WIP. So we're going to debit work in process for 87,000, and we're going to credit the manufacturing overhead for 87,000. So that would take care of letter E. And then letter F, it says we received a bill for the website services for $3,000. Remember, that's basically a selling expense. You can call that whatever you want to call it. I believe they call it website expense. I'll just call it selling expense. It doesn't really matter. Just something expense. That is for $3,000. And we've got the bill, so that's basically, it didn't say we paid it yet, so that's basically AP. So there's your basic rundown of all your basic entries. Now, if I go to the manufacturing overhead account, I'm going to draw the T account. Every one of these entries, look at what would have been posted into manufacturing overhead. In fact, let me write it over here so you can see my writing a little bit better. So notice what you'd have. You'd have 27,000. I see one of them. That would take care of part B. Part C was 45,000. So we got that as a debit. And it looks like we got another 26,000 going in there. And then it looks like there's the allocated overhead. Remember, that's on the credit side. So that would give you the 87,000. So if you added up the 27, the 45, and the 26, that's going to do debits and credits. That's a total actual overhead of 98,000. So there's your actual. The allocated was 87. So you can see it wasn't exact. So in this case, we're under. We're going to be under allocated by the difference. And the difference in this case turns out to be $11,000. So that would, so basically you would have $11,000 debit balance to overhead. And then of course, if you were going to close that one out, what you would basically do, they don't tell you to do it, but if you had to fix that one, then what you would do then is you would most likely debit cost of goods sold for $11,000 and credit the manufacturing overhead for $11,000, and that would essentially adjust the overhead to zero and adjust the cost of goods sold. Okay, last one I'm going to work with you is E-3-28A. And again, more practice on job cost, bid price at a consulting firm. So this again is a non-manufacturing, this is a service firm, but just to show you how you can still use job costing. Again, the difference is you're not going to have inventory. So again, it says they're a real estate firm. They specialize in advising companies on potential new plant sites. They use job order or job costing with a predetermined indirect cost allocation rate computed as a percentage of expected direct labor cost. Guys, this is the base right there. They tell you that right there. At the beginning of the year, they prepare the following plan or budget. So all this stuff is estimates right here. So we've got professional hours, we've got our direct labor cost, office rent, salaries, and utilities. It says Jamba Resources inviting several consulting firms to bid for work. Xander estimates that this job will require 100 direct labor hours. Okay, so that's the basic setup. So under requirement number 1, it says compute Xander Consulting's hourly direct labor cost rate and their indirect cost allocation rate. So this is basically the overhead rate, and also they want to get the hourly rate. So to figure out the hourly rate, just look at your direct labor cost here, which is $2,150,000. I'm going to write this up here at the top. And you also need to basically divide that by the number of hours that are going to be worked, which is 14,000. So that's basically a budgeted number. That comes out to right at about $154 per direct labor hour. So that would be part A. Part B, we want to get the overhead. Well, the overhead is basically these 3 items right here. That's going to be all of your estimates. So if you add up 220 plus 910 plus 290, that's going to give you 1,420,000. So that would be an estimated overhead number. And again, you're going to divide this by direct labor cost. So to get the direct labor cost, they've given that to you. That's the 2,150,000. So we divide that by 2,150,000. And then you're going to get a percentage. In this case, it's going to work out to be right at 66% of direct labor cost. You would type in, of course, 0.66. So that was basically requirements for part 1. Now, part 2 says compute the predicted cost of the resources job. So you got two aspects here. You don't have inventory, but you're going to have direct labor and you're going to have overhead. So the direct labor aspect of it, we know it says 180 hours at an hourly rate of 154. So you basically multiply 180 by 154. That's a total cost of $27,720 for the direct labor. The overhead, you're going to use that overhead rate, which is 0.66, and you're going to multiply that by the direct labor cost, which is $27,720. We just figured that part out. That's going to put you right at $18,295. So then you just basically add these together. You would predict a total cost of about $46,015. That would be your cost prediction using these amounts. Okay. And then in part 3, that kind of fell off in part 3. It basically says is that they basically price everything at 40% of cost. So if we were going to price this to a customer, we would essentially take the $46,015, multiply that by 1.4, and we would basically sell this to the customer. We would be bidding at a price right around $64,421. And again, this was part 3. It kind of got caught off at the bottom here, but that's basically what they're asking is what would be our bid price. Well, again, if we mark everything up 40% above cost, we would be bidding at around $64,421.